Welcome back to Mastering MHA MBA. This is Chapter 13 of Managerial Accounting, Part 1 of 4, based on Managerial Accounting by Datar and Rajan from Pearson. Last chapter we built the budget. This chapter is what happens when reality refuses to match it. We learn to measure the gaps between plan and actual, called variances, and turn them into insight. Part 1 builds the foundation, the difference between a static budget and a flexible one. No budget ever comes true exactly. Sales come in higher or lower, costs run over or under. The question is not whether there is a gap, but what the gap means. A single number, we missed budget by $50,000, is useless on its own. Was it because we sold more units, or because each unit cost more than planned? Those have completely different causes and completely different fixes. Variance analysis is the discipline of pulling those gaps apart so a manager knows exactly where to look and what to do. Start with the static budget. This is the master budget we built last chapter, based on a single planned level of output. Maybe you plan to make and sell 10,000 units. The static budget is locked to that number before the period begins, and it never changes no matter what actually happens. That is its strength as a plan and its weakness as a yardstick. Because if you end up selling a different number of units, comparing your actual costs to a budget built for a different volume is not a fair comparison. The simplest comparison is the static budget variance. Just take your actual result and subtract the static budget. If the difference helps profit, we label it favorable, marked F. If it hurts profit, it is unfavorable, marked U. Be careful with those labels. A favorable cost variance means actual costs were lower than budget. It is about the effect on income, not whether something is good or bad in a deeper sense. The static budget variance is a fine starting alarm, but it is blunt. It cannot tell you whether you missed because of volume or because of cost. For that, we need to get smarter. Here is the flaw in the static budget variance. Suppose you planned for 10,000 units but actually produced 12,000. Of course, your total material and labor costs came in higher than budget. You made 2,000 more units. That overage is not a performance problem, it is just arithmetic. Comparing the cost of 12,000 units to a budget built for 10,000 is comparing apples to oranges. To judge performance fairly, we have to first strip out the effect of producing a different volume. That is exactly what the flexible budget does. The flexible budget solves the problem. It takes the original budgeted prices and cost rates, but applies them to the actual level of output. It answers the precise question. Given that we actually made 12,000 units, what should our costs have been? It is the budget you would have written if you had known the real volume in advance. Because it holds prices constant and only adjusts for volume, the flexible budget is the fair benchmark. Now we can split the original gap into two clean, meaningful pieces. The first piece is the sales volume variance. It is the difference between the flexible budget and the static budget. Since both use the same budgeted prices and differ only in the number of units, this variance captures the pure effect of volume. Did we sell more or fewer units than planned? That is it. A favorable sales volume variance means you sold more than expected. This piece usually points toward the sales and marketing side of the house because it is about quantity, not about how efficiently you operated. The second piece is the flexible budget variance. It is the difference between your actual results and the flexible budget. Because both are at the actual output level, volume cancels out entirely. Whatever is left can only come from prices being different than planned, or from using inputs more or less efficiently than planned. This is the variance that actually measures operating performance. And because it is so important, the next two parts of this chapter are devoted to breaking it down further into price and efficiency for direct costs and then for overhead. This framework sat quietly in textbooks for decades. Then came the most violent cost environment in 40 years, and suddenly the gap between budget and actual became a survival issue. Here is what happened. Companies built their 2022 budgets in late 2021, assuming a fairly calm world. Then consumer inflation hit a 40-year high near 9%, and producer prices for manufacturers jumped around 13% in a single year, one of the largest gains on record. Budgets written just months earlier were obsolete almost immediately. The result was enormous unfavorable cost variances across nearly every industry. And here is the key point. The static budget variance just screamed that something was wrong. It took the flexible budget and variance analysis to reveal how much was rising prices versus changing volume. That volatility changed how companies use variances. Reviewing them once a month, well after the period closed, was too slow when input prices were moving weekly. So firms moved toward tracking variances much closer to real time, turning them from a backward looking scorecard into a live early warning signal. We will see the technology behind this in part 4. For now, just register the shift. Variance analysis went from a routine month end ritual to a tool companies genuinely depend on to survive cost shocks. Let us lock it in. The static budget variance is the raw gap between actual and plan, but it mixes two things together. The flexible budget, built at the actual output level, lets us split that gap cleanly. The sales volume variance captures the effect of selling a different quantity. The flexible budget variance captures everything else, the price and efficiency effects of how you actually operated. That second piece is where the real story lives. So we have isolated the performance gap, the flexible budget variance. But it still answers two questions at once. Did our inputs cost more than planned, or did we use more of them than planned? Those are very different problems with very different owners. In part 2, we split this variance into a price effect and an efficiency effect for direct materials and direct labor. See you there.